This year, on 8th of February, 4 out of 4 signals also converge to each other. Then, the Nasdaq suffers a pullback of 12.2% or 1,752 points of correction. Hello everyone, in this video, I will be sharing the warning signals that I use to warn me about a potential market correction. What are warning signals? Warning signals are a set of signals that tell me the probability of market correction is high. Using Nasdaq daily chart as an example, on 24 August 2020, all my warning signals such as EMA 20, Stochastic, RSI, and the Bollinger Band, 4 out of 4 signals suggested that the market is overbought and ready for a pullback. The index went higher to 12,050 on 2nd of September. Then, the Nasdaq had a 1,500 points of pullback or 12.7% correction later. Next warning signal appeared on 13th of October, where 4 out of 4 signals told me the market is ready for a correction. Then, the Nasdaq had a pullback of 1,154 points or a 9.7% correction later. This year, on 8th of February, 4 out of 4 signals also converged to each other. Then, the Nasdaq suffers a pullback of 12.2% or 1,752 points of correction. Next is 13th April. After 12 trading sessions, the market fails to hit new high and had a 1,210 points of pullback, corresponding to a 8.5% correction. The most recent warning signal appeared on 25th of June. After 12 trading sessions, it had a minor correction of 655 points, or 4.4% correction. However, there are terms and conditions as well as rules to applying warning signals in my analysis. Please make sure you watch this video until the end, otherwise, a misuse of warning signals could also be very costly. Indicators used in my warning signals. In total, there are 4 plus 1 indicators that I use as my warning signals. I will first use Nasdaq daily chart as an example to show how to apply these indicators. The first one is exponential moving average, EMA 20. For the details of moving average, you may refer to my previous video here. In short, EMA 20 is measuring exponential move of the stocks for 20 days, which is considered as a short-term movement. The red dotted line is EMA 20. What do you observe in this chart? First, EMA serves as a weak support for Nasdaq. Second, the more important point, when it moves further from EMA 20, it tends to pull back to EMA 20, either bounce on it or plunge through it. Thus, when the stock is moving far away from EMA 20, it signifies the stock could be pulled back anytime. Now, let us imagine EMA 20 is a rubber band. When we stretch the rubber band, the more we stretch, EMA moving further, the resistance is higher, and at one point, if we release the strength, it will be pulled back, or the stock pull back to support. Sometimes, the rubber band may be broken off, or stock plunges below the support level. Summary: the first indicator used in my warning signal is EMA 20. The further it moves away from the EMA 20, the higher probability the stock will be pulling back. The second indicator is Bollinger Band. Well, we know that stock tends to pull back to its support, such as EMA 20. However, we do not know how far it can stretch until it pulls back. Thus, here, we can introduce second indicator, Bollinger Band. Bollinger Band consists of a central moving average. In this case, I will be using EMA 20. There are 2 lines, one above and one below the central EMA 20 respectively. The distance of the band is based on standard deviation, which also indicates volatility. I am not going into details of the Bollinger Band as I am not using this as a trading signal. I will just share on how to apply this indicator as a warning signal. It is very straightforward. when the price hits the upper band, the price is relatively high. If it hits the lower band, the price is relatively low. You may also notice that the prices have a tendency to bounce between the bands envelope, touching one band then moving to the other band. Imagine you are in a tunnel with a lot of trampolines on the top and the bottom of the tunnel. You have found that you are bouncing in between. Thus, when the price moves far from EMA 20 and touch the upper band, it signifies the price could bounce back to the support or to the lower band anytime. Lagging indicators versus leading indicators. Moving average, such as EMA 20, is a lagging indicator because its value is computed based on the previous closing price. It simply follows the price with a delay. Bollinger Band, which is derived based on the moving average, is also a lagging indicator. Overall, lagging indicators confirm trends that are already taking place. It tells us the story of the past behavior of the price movement. Thus, lagging indicators can be too slow to help us anticipate the price movement. On the other hand, a leading indicator is a tool designed to anticipate the future direction of a price movement. It is kind of market prediction ahead of time. Leading indicator is computed in a way that it follows the price movement quickly. But as we know that market tends to gyrate a lot in a short-term period, the leading indicator tends to give us false signal. Relying solely on either lagging or leading indicator could have negative effects on our strategy. Thus, I added two leading indicators in my warning signals to balance it. The stochastic oscillator is my third indicator for my warning signal. The stochastic oscillator is a leading indicator, which is measuring the recent closing price of the previous trading range. You may wonder, since stochastic oscillator is still using recent closing price to compute its value, why is it considered as a leading indicator? Let's use this analogy. You are a marathon runner. Before the race starts, your energy is at the max level. When the race starts, you run very fast. The momentum is strong. You are running faster and faster. This is where the stochastic oscillator moving out. At one point, you will start to be feeling tired. This is where the stochastic oscillator at the top or overbought region. At this level, your energy is exhausted. You need a break. Thus, you start to run slower. Now, your running pace is relatively slower than your previous speed. Your momentum decreases. This is where the stochastic oscillator is going down or the price is pulling back. When you are starting to feel tired in marathon, which is at market high, I will anticipate you will be running slower later. Price pullback. When you are running slower and recharging to gain back your energy at market low, I anticipate you will be running faster later. Price going out. Thus, the stochastic oscillator is based on the idea that market momentum changes direction much faster than price movement, which taking into account the highs and lows in a recent range. So, it can be used to predict the direction of price movement. Let us look into the stochastic oscillator. We have a red color K line and purple color D line. We also have a reading of 80 and above as overbought region, and a reading of 20 and below marks the oversold region. In general, when K line crosses above D line and moves outward, it signifies the upward momentum is increasing. Conversely, when the D line crosses K line and moves downwards, it signifies the downward momentum is increasing. But for warning signal, I will only focus on one region, overbought region at the reading 80 and above. This is where the market is starting to feel tired, and the price could retrace back anytime. This is where we can use the stochastic oscillator in conjunction with EMA 20 and the Bollinger Band to double check if the market is prone for a correction soon. Relative Strength Index or RSI. My last indicator used in my warning signal is a well-known indicator, RSI or Relative Strength Index. RSI is also a leading indicator. RSI is also measuring the momentum of a price movement. It is very straightforward to read RSI. When it reaches 65 and above, the stock is considered overbought. When RSI is at 30 and below, it is considered oversold. Then, why do I need both the stochastic indicator and RSI in my warning signal? This is because they are computed in a different way. The stochastic oscillator is based on the assumption that an asset's current price will be closer to the highest price of its recent price range. In other words, stochastic oscillators use closing prices but also include the highs and lows in a recent range. Whereas an RSI would include just the closing price of a recent trading period. As a general rule, the RSI indicator can prove more useful when markets are trending, while the stochastic indicator can be more insightful compared to the RSI in flat or choppy markets, when there is no clear trend. Thus, by including both RSI and the stochastic indicator in my warning signal, I managed to monitor the market to provide me more insight on the potential pullback at various market conditions. Greed and Fear Index. Our community friend Jackson shared with us about the Fear and Greed Index. Thus, I also added it as my fifth reference indicator. If all the four indicators converge to each other, I will also double check with the Fear and Greed Index. Extreme greed signifies the market could undergo correction anytime soon. You could refer to this link to obtain the index. This is the summary table for the warning signals used. I will pause here for 10 seconds for you to have a look or copy it. Overall, these 5 indicators are computed in different ways, and thus, if they are pointing towards a potential correction, the likelihood for the market correction is high. By the way, when I found my warning signals converge to each other, I will also share it on JM Investing Circle Telegram group. We also discuss stocks and investing information there. Please feel free to join if you are also an investor looking for a like-minded people to profit in the stock consistently. The Telegram group link is available in the description. Do you know that we can also use similar setup to look for the good company that is oversold, but I am using different set of indicators. I managed to identify Fortinet at $120, SPGI at $324, Trax at $70 using this approach. Please subscribe my channel and turn on your notification bell if you would like to know how I pick the stocks with this strategy. How to apply warning signals in investing. This part is very important. Please make sure you watch the video until the end to get the full picture of the warning signals. I need to emphasize the following for the warning signals. First, I do not recommend in timing the market. In short, market timing is a strategy of making buying or selling decisions by attempting to predict future market price movement. Warning signals should not be used as an indicator to predict the downward movement of the stocks as a decision to sell stocks or short sell the market. Warning signals only tell me the probability of the market correction is high. It is not a selling signal. Selling signal should be based on your trading strategy. In general, when we already invest in stock market, there are 3 actions can be taken. First, buy more. Second, sell, profit take or cut loss. Third, do nothing. These are the information that warning signals tells me about. First, do not buy, wait patiently for the dip. If I have limited cash, sell part of the stocks to accumulate some cash or hedge my position with option. The third one is do nothing, just wait. Sometimes do nothing could be one of the best actions. Important, the warning signals are not intended to be used for these purposes. Sell all stocks and wait for the dip. This is timing the market already. The stock may just go higher and you miss all the profits. Short sell the market. Warning signals are not selling signal nor short sell signal. Let's take Nasdaq chart as an example again. While the warning signals managed to warn me about some of the major corrections, However, in the bull run from November 2020 to February 2021, we could see that there are at least 4 regions where both 4 indicators converge to each other. However, the retracement is very minor, and the market moved higher and higher until the major correction happened in February 2021. If we sold all our stocks just because of the warning signals, we could miss the profit of this nice rally. Thus, the warning signals are not a selling signal and should not be used to timing the market. However, the warning signals tell me not to buy during that moment and wait for the retracement, either minor or major retracement that happens most of the time. Strategies to apply warning signals. Thus, strategies to apply warning signals are very simple. Remember 2 principles when the warning signals are converged. First, just wait for the price to dip to the critical support. Second, then buy the stocks and we just hold all the way for long term. You can refer to my previous video on how to identify the critical support. In investing, we need to stay invested and hold long term to magnify our profit. If it does not hit the critical support, then I will just write the profit from my existing portfolio. Let's study these statistics. The data and source are extracted from their wealth management website. First, the longer we invest, the lower the risk of losing money. Thus, never trying to timing the market. This is why the warning signals are not intended for me to sell my stocks. It gets me ready to invest more later. Second, in the last 20 years, 70% of the best days in the market happen between 14 days of the worst ones. Thus, if the price retraces to the critical support after the warning signal, I will be happy to buy the stock and hold again. Then, I have a higher chance to enjoy the best days in the market. With this approach, I managed to get my Momo account hitting new high again and again since February when I first created this account, despite of several corrections from February to April. However, I managed to ride the nice rally in May to July. Overall, the warning signals are the signals to tell me not to buy at this moment, but prepare to buy later. That is all for my sharing on my warning signals to analyze the index. Which indicators are your favorite? Let me know in the comment. I will be sharing on how to set out warning signal in both TD Ameritrade and Momo platform in the next video. Before you go, please give me a like. Hope you learned something today and see you in the next video.